Hi, welcome to today's deep dive lessons from the Intelligent Investor. Common stock selection for the enterprising investor. Enterprising investors can seek undervalued stocks, companies in temporary distress, or those with growth potential not yet recognized by the market. Careful analysis is required to ensure that the issues are fundamentally sound. Investors should look for low price-to-earnings ratios, strong financial positions, and signs of recovery or future growth. Corporate bonds and convertible issues. Corporate bonds can offer higher yields than government bonds but carry more risk. Investors should assess the issuing company's financial strength and ability to meet debt obligations. Convertible bonds, which can be converted into common stock, offer potential for capital appreciation along with fixed income. Selection should be based on careful analysis of the underlying company. The role of investment funds. Mutual funds and other investment funds can offer diversification and professional management, particularly useful for defensive investors. Investors should evaluate a fund's past performance, fees, and investment strategy. Choosing low-cost, well-managed funds with clear objectives can help investors achieve satisfactory returns with less effort. The investor and market forecasting. Predicting market movements is highly uncertain and often unreliable. Investors should not rely on forecasts to make decisions. Instead, focusing on intrinsic value and the margin of safety provides a more stable and effective investment approach. Long-term success comes from sound principles rather than market predictions. Investor psychology and behavior. Emotions such as fear and greed can lead to poor investment decisions. Maintaining discipline, patience, and a rational mindset is essential. Investors should avoid panic selling during market declines and overenthusiastic buying during market booms. Sticking to a well-thought-out investment strategy helps resist emotional impulses. Risk and return. Risk and return are closely linked. Higher potential returns often come with higher risk. Investors should assess their own risk tolerance and build portfolios that align with their comfort levels. Diversification, margin of safety, and thorough analysis help manage risk while aiming for reasonable returns. Earnings, growth, and valuation. Investors should focus on companies with steady earnings growth at reasonable valuations. High growth does not justify excessive prices. Even excellent companies can be poor investments if bought at inflated prices. Evaluating both growth potential and current valuation ensures more balanced investment decisions. Special situations and opportunities. Special situations include mergers, acquisitions, spin-offs, or restructurings that create temporary mispricing. These opportunities require detailed analysis and active monitoring. Enterprising investors willing to dedicate time and resources may find attractive returns in these situations by recognizing value others overlook. The importance of patience. Successful investing requires patience. Market prices may take time to reflect intrinsic values. Rushing to buy or sell based on short-term movements often leads to losses. A patient approach allows investments to grow and market inefficiencies to correct over time. Dollar cost averaging. Dollar cost averaging involves investing a fixed amount at regular intervals, regardless of market conditions. This strategy reduces the impact of market volatility and helps avoid emotional decisions. Over time, it results in purchasing more shares when prices are low and fewer when prices are high, leading to more favorable average costs. The danger of overtrading. Frequent buying and selling can erode returns through transaction costs and taxes. Overtrading is often driven by emotion or an attempt to time the market. Investors should adopt a long-term perspective and minimize unnecessary trading to preserve gains and maintain focus on fundamentals. Growth stocks and caution. Growth stocks can offer attractive returns, but often come with higher valuations and greater risk. Investors must carefully evaluate whether growth expectations are realistic. Overpaying for growth can result in disappointing returns if the company fails to meet high expectations. A balanced approach to growth investing is recommended. Understanding financial statements. Analyzing financial statements helps investors assess a company's health. The balance sheet shows assets, liabilities, and equity. The income statement reveals revenues, expenses, and profits. The cash flow statement highlights how cash is generated and used. Understanding these documents is crucial for making informed investment choices. Bankruptcy and loss prevention. Investors should avoid companies with high debt levels and weak financial positions, as these are more susceptible to bankruptcy. Signs of financial trouble include declining earnings, reduced dividends, and excessive borrowing. By focusing on strong balance sheets and consistent performance, investors can reduce the risk of significant losses. The value of independent thinking. Independent thinking is essential for successful investing. Following the crowd often leads to buying high and selling low. Investors should rely on their own analysis and judgment rather than market trends or popular opinions. Independent decision-making helps uncover opportunities others may miss. Conclusion. Investing with a focus on intrinsic value, margin of safety, disciplined analysis, and long-term perspective offers the best path to satisfactory returns. Both defensive and enterprising investors can succeed by tailoring strategies to their abilities, risk tolerance, and commitment to continuous learning. Avoiding speculation, maintaining patience, and thinking independently are crucial principles for achieving financial success. Thank you for listening, and please like the video and subscribe for more great upcoming content that will put you in top 1%.